All the top economists and central bankers around the world are in one location. They're in Jackson Hole, Wyoming, a monetary policy symposium. They're talking about it all. Fed Chair Jay Powell just spoke. They did a review of long-term issues in the economy, but he talked specifically in his speech a little bit, and he signaled what the market is interpreting to be a rate cut in the September meeting. So markets, as we record this, are going wild, particularly the small caps, which are dependent upon their rate cuts. This episode is brought to you by Fiscal AI, the fastest growing stock research terminal on the internet. You'll hear more about Fiscal later in the show. Let's get into it. I'm joined, as always, on these special episodes by my friend and business partner Max Wiethe. Max, let's get into it. What do you want to talk about first?
Obviously, what Powell said about the short term is what people are most focused on today. A lot of the speech, as we'll talk about later, was on long term and how the Fed just thinks about its monetary policy tools and its framework. That is pretty interesting, but clearly the soundbite that everybody grabbed onto was that based off of the new data, it might be appropriate to adjust the stance of monetary policy, which, as you said, is Fed speak for we're probably going to cut guys. So everybody grabbed onto that. The market really reacted. We're seeing bond markets are rallying, rates are headed lower. Accordingly, currencies are reacting. The dollar has weakened to the euro, and equity markets are absolutely ripping with the Russell and the most speculative stuff sort of leading the way. And then the truly like rate link stuff like housing just absolutely flying. Um, were you expecting this level of I don't know if it's appropriate to call it dovish at this point, given how many times people have said, that they should have been cutting rates, but were you expecting him to be this crystal clear?
Well, I don't think he was that crystal clear. I'd say this is pretty roughly within my expectations. Max, you have made the point to me that the market is kind of interpreting it as a certainty. When we last recorded, the odds of a cut in September was about 90%. Then we had a producer price index, very, very hot reading, so hot inflationary reading, and that caused the odds, the market implied odds of a cut to go down. But now that Powell has sort of reaffirmed that, the market is now at 90 chance of a cut. But I think if you actually, we listen to the speech, we look at the transcript right now, the real Moneyball quotes of saying we're going to cut is it's pretty mild and kind of implied. He said the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Now, I'm not a expert in reading Federal Reserve speak, but they do typically kind of leave things up to the implication rather than just saying we're going to cut rate. They kind of just imply things. But even this, I still think theoretically could not cut in September. I think that's unlikely, but they theoretically could. And also, Max, we've got some data. Next week, I believe on Friday, we've got the PCE. So personal consumption expenditures, and that, of course, includes the price index, which is the Federal Reserve's 2% target. And then, of course, as August comes to a close in early September, we get the August non-farm payrolls and then the inflation report, I believe, on September 11th. So that we do have another round of data before the Federal Reserve meeting in the middle of September, and I guess there could be some shockers. But yeah, the market has interpreted this as purely dovish, and it's also interesting, Max. The financial conditions are remarkably easy, credit spreads remarkably easy, stock market at all time highs, and you kind of think that okay, everything is priced for perfection, and I can't keep on over delivering. Like who isn't invested in this bull market? Like what bears are there to turn into bulls? It doesn't seem like there are that many, but clearly there are, and yeah, the market just keeps on rising.
Somebody that we have had on both of our shows, Warren Pies, put this out on Twitter actually right before Powell spoke, and he called it his Jackson Hole dilemma. And he said, when core CPI is above 3% and rising, the Fed has only cut rates one time. So if the August CPI print comes above 3%, then a September cut would be the second only case of this. The only other time that's happened was December 2024, which now looking back has largely been considered to be like somewhat of not a major policy error, but clearly they didn't make any moves after that. So it will be interesting to see. And just, methodology, they're saying that rising is year over year on a 3 month look back. So has year over year risen over the last 3 months? It would be the only time. It is going to be interesting to see what happens because I think we are going to get that data point a couple days before the Fed. We've got PCE. Now, they talked about employment. I mean, that was really also one of the things that people glommed onto in the speech was that they said the employment risk is to the downside and it could materialize quickly. So we do have some employment data. What would you be looking for to really see that materialization?
I love Warren. I got to look into his methodology. I think a lot. Let's be real. The last inflationary shock we had, before 2022, for real, was during Volcker in the 1980s, and the way that they managed interest rates was different. They didn't just like pay interest on reserves. They managed the quantity of reserves, and they also had like an extremely wide range. From we're going to target the effective Fed funds rate from 10% to 12.5%. It's a huge range. So I don't know. I mean, were there some times in 1980 where inflation was above core CPI was above 3% when the Federal Reserve quote unquote cut rates, but they didn't actually cut rates according to Warren's dynamic because it was different. Like maybe I don't know. But yeah, I also think that the labor market is weakening. The Federal Reserve doesn't really like to use that word. You use the word softening, but I think it is weakening. And Powell is openly acknowledging now that the labor market is moving into what we would call a new balance where the amount of jobs being added is small. However, the amount of quits and the amount of firings is low. So actually, the labor market is in balance, but he called it a curious balance because basically everyone's stuck where they are. So the unemployment rate is not going up, not because everyone's being hired, tons of hirings and tons of new jobs, but because no one's leaving and no one's being fired. And then immigration, of course, plays a role in that. So look, I think it makes sense to cut interest rates. I'm sure the White House is going to be pleased on that. I think, and Powell said this, that their only concern when focusing on interest rates is their dual mandate, and I believe that to be true. But I think that the White House is definitely going to be pleased with this announcement to cut rates, and I don't think this was by any means Powell caving to Trump or anything like that. I think it makes sense to cut rates.
Jack, what about some of the longer term implications of Powell's speech? There are things like the average inflation targeting that the Fed adopted that they really took a look at over this meeting. And, this is not an FOMC meeting where they're debating should we cut rates, today or in the next few days. This is a meeting where they're really taking a look at monetary policy, the tools they have, and is it appropriately addressing the problems that it's supposed to be managing in the economy over the long run? And that's really what Jackson Hole is about. And they talked about that at the end of Powell's speech. What did you think about that section?
Right. So at Jackson Hole, they have a ton of economic researchers there. Like in 2023, Barry Eichengreen, I think, had the presenting paper on living in an age of high debt and something. And obviously that, is only tangentially related to the Federal Reserve. But uh, s- but they do like to focus on their monetary policy reviews, which they now do every 5 years. In 2020, they announced a tweak to their framework. And again, the framework is how to interpret and effectuate the mandate given to us by Congress for stable prices and stable labor markets. And basically, in 2020, because they had close to 15 years of low interest rates and high unemployment and a sluggish economy, they adapted something called the flexible average inflation targeting, basically saying that if you had been undershooting on inflation for a while, it might be okay to overshoot for a small while to sort of catch up. So that if you for 5 years CPI has been at 1.5% and your target is 2% for PCE, then 50 basis points a year, maybe you could have a little 50 basis points of overshooting for a while to sort of catch up. And the other tweak that they did in their 2020 review, Powell talks about it today, was acknowledging that talking about the Phillips curve, the connection between employment and labor, basically saying that if you had an overshoot. Um, basically targeting shortfalls from the natural level of unemployment. So there's a level of jobs at which it's not inflationary, and basically they would say that they talked about shortfalls to that, basically saying that they weren't as concerned about overshooting and being overhot in the labor market rather than being too cold. Powell has is now moderated that, and he said, "Well, we're taking out the term shortfalls because that was being misinterpreted by the market." But basically, on a longer term basis, it's a uh, lower tolerance for overshooting of inflation, a lower tolerance for excessive job growth that can contribute to inflation. Of course, jobs are good, and everyone says jobs are good, but like it's the Federal Reserve and economists have a thing that if there's a lot of jobs market's too hot, then wages are too high, and that will contribute to inflationary pressure. So this is a long term, slightly lower tolerance for inflation and lower tolerance for job growth. Again, the Federal Reserve would say, and I think they're largely correct, that like in the changes in 2020 were just little tweaks. It's not like they said, "Oh, we love inflation now," but it did because they had a decade of low growth, low inflation, and low interest rates. That was their framework. They're now adjusting that. So Powell talked about that, and actually, everything I'm talking about is from Powell's speech that the FOMC just did, I believe, and released their policy guidelines. Obviously, there's been like a ton of staff research going into it beforehand, but I think the framework is now live, and we can link to it in the description. Fiscal AI is the fastest growing stock research terminal on the internet. They combine a modern user experience with complete financial data on all stocks globally. Not only does that include 20 years of standard financial statements, but they also track company specific segments and KPIs on over 2,000 companies.
That's right, Jack. Want Amazon's cloud revenue? They've got it. How about Spotify's premium subscribers or segmental analysis of the different luxury verticals at Hermes? This is data that other platforms just don't track, even though it's the data that really matters. They've got all of that and literally millions more data points. And unlike legacy equity research platforms, Fiscal AI's data is real time, so it's updated within minutes of company earnings reports.
And Max, there are so many more features, including earnings calls, transcripts, financial modeling, best in class charting, portfolios of super investors like Stan Druckenmiller and Chris Hone, and they even have an easy to use data API so you can export data and build your own models in Excel. Fiscal AI is changing the way investors conduct equity research, whether it's individuals like us or institutional investors like Van Eck, who have their whole research team on the platform. But don't just take our word for it. Sign up for a 2-week free trial at fiscal.ai/mm to see for yourself. And if you upgrade, our link will get you 15% off your first year on any of their paid tiers. Again, that's fiscal.ai/mm. Let's get back to the interview.
So, Jack, obviously Jackson Hole is the headline right now with the Fed, but there's a lot of other drama going on. And Lisa Cook is under investigation for allegations of mortgage fraud. We were watching the press conference from Chair Powell, listening to his speech. And after it ended, they pointed out on Bloomberg that somebody was making a ruckus in the lobby of the lodge where the symposium was taking place. And a former guest of your show, James Fishback, the quote unquote head of macro, who has actually sued the Federal Reserve, was in the lobby and was yelling at Lisa Cook, and he was removed by sheriff's deputies. So there's a lot of drama going on around the Fed. Obviously, the president is talking about the Fed much more than they ever have. What is going on with Lisa Cook, Trump, and all of this excitement?
So President Trump, it's no secret that he has wanted the Federal Reserve to cut rates, and he has been public calling on the Federal Reserve to cut rates, calling Powell Mr. Too Late, as in Powell is too late. The Fed is too late to cut rates. That by itself is definitely a departure from decorum because there is a strict line of central bank independence. Interestingly, the central bank independence kind of emerged in the 1980s and 90s. It's not like it's existed going back to ancient Rome or something, but it is a tradition, and President Trump is definitely departing from that. More recently, he has stepped up his demands, he's basically saying he's not going to fire Powell. I mean, sometimes among some Republican senators, he'll say, "I'm going to fire Powell." Then that will be reported on Bloomberg. And then when he's asked about it, he said, "I don't want to fire Powell. I'm not going to fire Powell." So he's definitely been some moderation. I mean, Besant would call that strategic ambiguity, but he is, I think, looking at who can he take out of the Fed and who can he put into the Fed who has a more dovish tone. Adriana Kugler is resigning, so she's going to be off the Fed. And Steve Mirren, who's currently the chairman of the Council of Economic Advisors for the president, is President Trump has nominated him. So that Steve Mirren is definitely someone who has worked with Trump. I don't know if he may be dovish. He certainly had a more of a hawkish tone a year ago, but the data has changed, admittedly. So we'll see about that. And then Chair Powell is going to his term ends in the spring of next year. His term as the boss of the Fed. The question is he going to stay on as governor? So if he doesn't stay as governor, there's another place Trump could put another person in who could be more dovish. And then Trump more recently is calling on Lisa Cook to resign because she from the Federal Reserve Board, because she, according to FA director Bill Pulte, has some committed mortgage fraud. I think if you look into mortgage fraud, I think you kind of think of just stealing money, but the allegation is that she checked a box for a property that was going to be her primary residence, but it wasn't her actually primary residence. I don't know if this is true. I don't know if there's any merit to it. I don't know if this happens at all, but I don't even have a view on a firm view on whether it is appropriate to fire or have people resign from the Federal Reserve for this type of thing, or how common that is. I mean, definitely, like, if you look at the president's history in real estate, like I think President Trump, there are stories of this from when he was working in the real estate industry, of hiring some people, non-union contractors who had associations with the mob. Like, and I've never gone public about calling President Trump out on that. That's not really my beat. My beat is the Federal Reserve, and I think that this is definitely politically motivated. Like, I don't think that President Trump and Bill Pulte are horrified at this alleged mortgage fraud. I think Trump wants someone out who maybe he perceives as being on the capital D Democrat side, and he wants to put someone who's a Trump loyalist or someone who's going to be cutting rates in. That is what I think that Trump wants. And to be honest, I do oppose that, not for any political reasons, but just because I do believe in central bank independence. And then, James Fishback, he is definitely a huge ally of the president, an entertaining character, a smart person. He is definitely jumping all over this, and he said, she's got to resign in a pretty aggressive fashion. I would like to interview James. I mean, I don't know if he would say he believes in central bank independence, but it would be interesting to have James on to talk about that.
Well, I know he has lobbied to, put himself onto the Federal Reserve. I don't think that is super likely. Actually, we now have these prediction markets, which are just interesting for their informational value. I pulled up Kalshi while we were talking, and they have an open prediction market on who Trump will nominate as Fed chair. And right now, Christopher Waller is in the lead at 31%, Kevin Warsh at 19%, and Kevin Hassett at 19%.
It's funny, Waller used to be a mega hawk during 2022. He has now moderated his stance and believes the Federal Reserve should cut. I have a lot of respect for Waller, and President Trump is definitely not listening to me, so some random macro podcaster. But I think that I would, of those three choices, I think Waller is clearly the choice to go with.
I would say the big wild card that has come into discussion in the past couple of weeks is David Zervos from Jefferies. I don't know how familiar you are with him, Jack, but he has pretty incredible hair. If that was a requirement for the Fed, he would definitely get the nomination. He does macro strategy at Jefferies, and he's a name that people have been talking about. So we'll see. There are quite a bit of horses in the race, but it's not clear who is going to take that. Sorry.
Yeah, and also I'd add two wild cards. I mean, a true wild card would be Steve Mirren. I mean, he's going to be nominated to a board seat, so I don't know how likely that is. I'd also say Scott Bessent, Treasury Secretary. He's denied it, said he only wants one job, but I feel like it's a wild scenario that is technically possible, I would say.
They're both at Mirren is actually slightly ahead of Bessent in the prediction markets at
Mm.
5% and
Okay, I didn't
4%,
even know that.
just below James Bullard. Um, so there are quite a few people in the race and some big names. I would also like to add, Jack, that this specific type of mortgage fraud allegation is something that is not just limited to Lisa Cook. Here, where we live in the state of New York, the Attorney General obviously is a political enemy of the president. They brought charges against him in New York State. Part of the reason he can't pardon himself is because they were state charges. Um, and Attorney General Letitia James has been accused of the same form of mortgage fraud. So clearly, political enemies of the president are being looked at for this type of thing.
Right, and I also, the president has faced a lot of political challenges of the justice system going after him, and he has called basically all of those attacks witch hunts. And I think a lot of attacks against Trump, whether they're true or not, are definitely politically motivated and somewhat are witch hunts. I think that this is what President Trump is doing is definitely a witch hunt against Lisa, for sure.
So, Jack, I know we want to close with discussion of some companies and some markets. We've been talking about earnings a lot over these past couple of episodes, but really focused on some of the big bellwether names in the market that have been driving the bull market. You and I, we are following those names. We are sometimes invested in, large mega cap stocks. Um, but at the same time, as individual investors, we have the benefit of getting to invest in all sorts of companies because we don't really have a mandate and we don't really have liquidity concerns. So we can play around in some fun esoteric corners of the market. Up to this point, we have largely refrained from talking about our personal portfolios and individual securities. We're still going to try and strike a balance between that. But I think today, a sector that you and I have both been closely watching has reported a lot of earnings this week. And they're just really interesting companies that we wanted to talk about here today. So, to everybody, if this is something you want to hear more of, or if it's something you don't like, please let us know in the comments. This is new for us. But we are excited to talk today about the Chinese fintech companies, many of which are listed on US exchanges here as ADRs or ADSs. Jack, this is a sector that you really turned me onto. So I'm going to turn it over to you. What was it that got you interested in these Chinese fintechs, and what did we see this week in earnings?
I think what first turned me on to these was how cheap these names are. Then I learned more and more about the businesses. I've been involved for about 18 months in these Chinese fintech stocks, and there are six of them. And by Chinese, I'm talking about a very narrow band. I'm not talking about wealth management or brokerage firms like Futu, for example, is a name quite known. I am referring to the online consumer lending platforms. Sometimes they lend to small businesses as well. And they have a capital light model and a capital heavy model. The capital heavy model is they use their own capital to and make loans. And the capital light model is that they have what they call institutional funding partners, which are mainly banks, but also insurance companies in China, who they facilitate the loans on behalf of those institutional funding partners, and the institutional funding partners make those loans. First of all, I want to say that I think anytime you see a lot of opportunities come from a crisis, and the crisis that not a lot of people know about, but in Chinese, it's kind of niche, but in Chinese fintechs was there's a huge digital lending boom in starting in roughly, let's say, I mean, one of the companies, again, I own all these companies, just so you know, but Finvolution, I think was founded in 2007. So that's probably one of the first ones. And that at first was a peer-to-peer lending model, sort of like a lending club in the United States, which is like Max is an investor and he wants undifferentiated returns. So he lends to Jack on lendingclub.com. In America, like those delinquencies are 5, 8, 15, 20%. Like in America and a lot of countries around the world, like consumers have a tendency sometimes to not pay back their loans. And one thing that really struck me, Max, after the valuation was just how low the delinquency rates are in China. China, as many people know, is not a consumer society in the or economy in the way that other countries are, particularly the United States. Consumption as a percentage of GDP is much smaller. They're much more of an investment driven economy, investing in real estate, investing in manufacturing for internal consumption, but also particularly exports and being an export powerhouse. And so the growth of consumer lending in China from, let's say, 2007 to 2018 was, a lot of it was peer-to-peer lending and these so-called WMPs, wealth management products. And these were quite toxic and, if not scams, like scam adjacent. Like they were making quote unquote legitimate loans, but I think a lot of people, particularly the small time investors in China, kind of got burned. So in 2018, there was a giant crackdown on all of these companies. And so some of the companies that had already been public and they had made listings in the New York Stock Exchange got absolutely annihilated. And then in 2020, there was a official rule being posted. It's funny, like the crackdown comes first and then the rule comes out later. So if you're looking at, oh, the rule just got released, like it really is kind of 2 years late, and being posted in 2020. And even though there was a surge in the share prices in 2021 of these Chinese fintech stocks, really the consumer credit that they were making in terms of facilitated loans was going down and down and down. But that bottomed in 2022, and the facilitation of loans from then until now has been absolutely huge. And they have moved to a new business model where they're lending mostly institutional funding partners, as well as to a lesser degree their own capital, depending on the company. So the peer-to-peer business model is out. The Chinese small-time investor is no longer being lured by earn 15% and then they don't pay, people that don't pay back their loans. It is the banks that are making these loans, and also I think the I think that these loans are a pretty good credit. They earn 10, 15, in some instances 20% APR, and the delinquency rates are around 2%, in some instances below 2%. There's one Chinese fintech I just looked into, and their 30-day delinquency was like less than 1.20%. And if you look at American Express, their delinquencies are at 2%. So in China, what is considered slightly subprime has the same delinquency rate as an American Express customer in America, which is obviously like a wealthy customer who you viewed as a very high credit. So the real lesson I would say is that in China, real estate development companies, well, they don't pay back their loans, and there's a huge credit issue. But Chinese consumers pay back their loans, and they are a good credit. So yeah, I've been involved with one or two of these names for a while. I'll talk about all six of them, and currently I own all six of them, but with quite different levels of concentration. I don't think I feel comfortable revealing like which one is my favorite or the like, but I will talk about all six of them, and we can just talk about the ecosystem. And they've been ridiculously undervalued in my view to somewhat fairly valued. They recently had a dip like going into this week, so I was quite an aggressive buyer, to be honest, and they actually have rallied tremendously over the past like literally 2 days. So I had been kind of lightening my bag, not because I'm not bullish, but just because my concentration in these names is just like so ridiculously big.
You were going overweight into earnings. They had sold off. You felt that earnings were going to be strong. You were overweight into earnings. You are now taking off some of that extra weight, but that does not change your long-term bullish view on the names.
Yes. So let's talk about why it's actually Yiren Digital. I think that literally translates as credit ease. So it's a pretty funny name, kind of in the name. So again, we're actually using our partners at Fiscal.ai. Anytime we look at individual stocks, we use Fiscal.ai. It's a wonderful platform, and people can get a discount by using our link. It's really recommended. But look at loans facilitated in the second quarter of 2023. It was 8 billion Chinese renminbi. In the second quarter of 2025, it was 26 billion in RMB. And this is very similar across most of the six Chinese fintechs. So just the amount of consumer credit that has been generated over the past 2 to 3 years is enormous. And I think that that's a macro story that people are definitely not paying attention to. Like everyone's paying attention to Jackson Hole. Everyone's paying attention to Powell. A lot of people are paying attention to the home builders, to the job market, Walmart earnings. But if you want to look at like differentiated stuff, this is definitely differentiated. And I think that this is not even a major factor of the Chinese financial markets. Like definitely the biggest shift over the past 4 years in Chinese financial markets has been a shift from the Chinese Communist Party telling banks from lending to lend to real estate companies to stop lending to real estate companies and lend to advanced manufacturers, lend to electric vehicle companies, lend to 3D additive manufacturing facilities and new manufacturing. But also, I think the Chinese Communist Party has somewhat endorsed the Chinese consumer platform. And again, I don't think necessarily I'm even making a prediction about the future. I think I'm talking about the past 2 to 3 years. I have looked at the CBIRC, actually, that's now the NFRA. They changed their names, and these are regulatory agencies. Unlike the Federal Reserve, they are not independent, but they make sort of rumblings about we basically are okay with Chinese fintech, and so I think uh, if loans are growing at 70% a year in a particular category, I think in China, like it's because the government is approving of them. Actually, on April 1st, there was a announcement from uh, the Chinese Communist Party, basically putting in new regulation that's effective on October 1st that effectively is going to limit the growth. So I actually think that like the credit growth is not going to continue to be growing at 70% year over year, but I actually think that is a good thing. However, one thing we saw in these earnings reports is that they're they're guiding for slightly lower credit growth. Year over year, it'll still be a big number, but quarter over quarter, it could actually be a decline in credit growth. So I think that could like weigh on the share prices to short-term traders and somewhat uninformed investors. So I urge caution about being in these names. I mean, one of the stocks that I've been involved with, uh, literally has had I think multiple days of being up or down, excuse me, down 25% in a single day. So obviously, like if you're a 60-year-old who's like has 3 kids in college and like you're using money to pay for your kids' college, like I would not recommend a large allocation. But if you have a high risk tolerance, like I have a high risk tolerance and I'm involved in this names and I can only tell people what I'm doing.
You said a lot of these you think are extremely cheap. Cheap means different things, right? Some people look at a company that's trading at 18 times earnings and say, "Oh, well, that's cheap compared to the Mag 7." What does cheap mean in these companies? And then also, what about capital returns? Are they, paying dividends? Are they doing buybacks?
I'm really glad you asked, Max. Let's go to our partners at Fiscal.ai. I just used their charting function. This is the price to earnings ratio. So you'll see like Finvolution, which is, I believe, the oldest company, currently has a PE ratio of 6. In this category, that 6 is wildly expensive. Lex has a PE ratio of 5. JFin has a PE ratio of 3. XYS PE ratio of 2.79. QFin PE ratio of 2.16, and Year in Digital PE ratio of roughly about 3. So these companies are cheap now. Now, again, like if you were to zoom out on this chart, go back over the past 10 years, you'll get some funky stuff because like consumer whenever a company has like a quarterly loss, the P ratio basically is like infinity or negative infinity. And in the first quarter of 2020 or during 2020, some of these companies reported losses. But I will say that like if I did in XYF X Financial, I looked into their losses in Q1 2020, and some of the losses are because they actually facilitate credit themselves, but also they do write credit guarantees, which is basically to their institutional funding partners. They are uh, have a guarantee of they take a certain percentage of the losses in XYF financials for certain loans. It is a 20% loss, and that is a model that I actually think in Europe and in America in the West, uh, the sort of guarantees do exist. I think in the financial world, but like you never really will encounter them in presentations. But I think in the Chinese financial sector and in China in general, this use of guarantees is more common. And I remember reading an article in the Financial Times about literally Chinese venture capital funds had like lost money investing in some Chinese venture VC funds, excuse me, VC companies, and they like threatened to use this clause that basically anytime a company raises money in China from a VC, they basically say like we guarantee you won't lose money, and it's never actually enforced. But I think that that is something to be aware of. So look, anytime a company, I mean, I've acquired some of these companies at 1.5 times earnings. So anytime some company is trading at 1.5 times earnings, something had gone wrong and something is perceived to be wrong, and there are definitely risks. But your question is, what is being priced in terms of the risks versus what I assess the risks to be. So Jiayin, for example, is, I would say, the purest capital light business model in terms of facilitating loans only for institutional funding partners. And that actually, I have liked Young in the past, to be honest, but that business model actually could be the most challenged in the near term because the April 1, like, Chinese Communist Party regulation basically said, like, whoa, whoa, slow down here to the bank. So on the earnings call, they said that the institutional funding partners are kind of slowing down a little bit. But these business models are slightly different from each other. So, for example, let's see, LX, they also have an insurance brokerage business. XYF, they make some of their loans themselves. QFIN, they make some loans themselves. They actually, I'd say, have the biggest balance sheet. Another thing, Max, I'll do is I'll just go to Fiscal, who owns these companies. So let's do ownership. Like Yiren Digital, their biggest holding is a uh, Credit Ease holding company that's out of the Cayman Islands that is mostly itself. So that I think that is like the founder, JFIN. You look here, ownership, 63% is by Ding Yan, the founder. And if you look into the annual report, you'll see some of that is B shares, some of that is A shares. So a lot of these founders have 40, 50, 60% of the ownership power and 80, 90, 95% of the voting power. So you definitely are making a bet. And I am making a bet that these guys are not fraudsters. But you look at who owns these, and it's not like BlackRock. These funds are not in the big ETF. So it's like, who owns these? The founders, insiders, and then for example, UBS asset management, as well. Like another one was hedge funds. Another one was like the Fidelity Special Situations. I look at the top holders and I see somewhat sophisticated people, and I that is definitely not a reason to buy. Um, but it is a reason to add conviction to a thesis of like, oh, other smart investors kind of agree with me with my analysis, and I kind of like that, and that's how I use Fiscal.
What about the dividend yields, Jack? Can you show me that chart that you did of the
Yeah,
PE,
yeah.
but of dividend yields? Because a lot of them are paying dividends, and certain ones are also, while paying pretty high dividend yields, are also engaged in pretty aggressive share buybacks.
Yes. So, Max, these dividend yields right now are range from 2.9% to as high as 7%. JFIN literally had a dividend yield that was in the 20-25%, and on an intraday basis, north of 20%. I also think if you look at the buyback yields, they are enormous. XYF is definitely the biggest buyback as a percentage of shares. I'd also say, QFIN, if you go to the holders list, a owner is Norges, which is the world's largest institutional investor, the sovereign wealth fund of Norway. And actually, the the guy who runs Norges, he Nikolai Tang, and he also has a podcast that's very excellent. So somewhat a competitor, but someone I look upon very favorably. So I just I like these names, and I think they will continue to return capital to shareholders. And I think that it's amazing to me how low the delinquencies have been, given all of what you at least read China is going through. Like, China is going through deflation, and the property prices are continuing to go down. I believe the rate of change of decline in real estate values is going down a lot. So I think, like, it's China real estate prices may have bottomed or close to bottom, but like, basically, if you look at the scale of the real estate stuff, it's way worse than 2008 in the United States, and yet you have a huge consumer lending boom. Not only is consumer loans, not shrinking, but consumer loan growth is growing, and the delinquencies have been low. And recently, for some companies, they have continued to go down and down. Um, I'd also said that there are differentiators in between which some companies have a higher risk profile. Like Jiayin, I think, has among the lowest delinquencies, but again, they're making the loans on behalf of institutional funding partners. So even if the delinquencies were like higher, uh, their risk would be limited. Also, Max, big risk is this guarantee model may or may not be illegal. So again, the business models that if the business model of selling guarantee services is it is a legal gray area, and like in the risk disclaimers for these companies, they will say we we don't know, we're seeking regulatory clarity. So it's kind of a little bit like how crypto was performing. It's like, oh, is this legal? Is this illegal? But I think that the remarkable growth, I view that as evidence that the Chinese Communist Party has been easing that. And also there's just different models where they they're they're using third party guarantee services, and uh they the third party guarantee services guarantee a certain part, and those companies guarantee another part. So there are regulatory, people can really nerd out and look into it. And I would recommend, do your own research, obviously, and nerd out, like I have, before making any investment decision, whether to get involved at all. And this is definitely not an inducement to buy my bags, because I'm quite pleased with my bags.
Yeah, and we'll just close with a classic disclaimer that nothing we said here is investment advice. Consult your investment advisor before making any investment decisions. Jack, we'll leave it right there. Thank you so much for having me here on this Jackson Hole closing day.
I'll leave a quick shout out, which is stay tuned for my episode with Bill Moreland, someone who's really in the weeds on American banking. And particularly, he's basically saying that a lot of the very low delinquency rates of American loans to real estate, to consumers, is because American banks are modifying these loans, and that has always been a practice. But they are modifying these loans and setting them to a lower payment window so that they appear non-delinquent for 12 months. And then once they've been paying for 12 months, they suddenly appear as non-delinquent, and as non-modified. And that is a regulatory change that has happened recently. So that may lead, like, it may have caused delinquencies in the U.S. bank loan market, for consumer, commercial real estate, and commercial industrial to appear lower than they actually otherwise would be. So I think that interview should be going out this weekend, and I think it's a long one, but the nerds will really like it. People follow me on Twitter at JackFarley96, you on Twitter at Max Wiethe with an IE, and of course the OPM Pod, your podcast, Other People's Money. Thanks again. Until next time. Thanks for listening. Looking to check out Fiscal.ai's innovative equity research terminal? Get your 2-week free trial and 15% off your first year at Fiscal.ai/mm. Until next time.
Thank you. Just close this door.